Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Tuesday, June the 3rd. Welcome to our Global Markets Commentary. May saw a continuation of the positive developments for the global economy and capital markets that began in mid-April. More feedback from the bond market and more checks and balances chiming in brought more changes to the U.S. administration's tariff agenda and budget plans. Bond markets were soft, but global equity markets added to their late April rally. Critical feedback continues to come from the bond market. Recall, declining equity markets are a tangential signal. Rising bond yields immediately grab attention as they impact government finances. For just the second time since the 2008 Great Financial Crisis, yields on 30-year U.S. Treasury bonds crested 5%, before retreating as politicians acknowledged this important signal from the bond market and changed their tone. Other feedback loops we have pointed to chimed in as well. The codified checks and balances foundational to trust in the U.S. system of government began to weigh in, with court rulings that President Donald Trump had overstepped his bounds on some tariffs and other areas. We note that these legal battles are just beginning. The striking down of some tariffs introduces additional uncertainty as the administration pivots to other methods to achieve its goals. Higher bond yields, usually not a stock market-friendly development, were shrugged off by equity investors as they appreciated the impacts the rising bond yields are having on policy choices. There are limits to this, but for now, investors celebrated the tariff reprieve more than the weight of higher bond yields. A typical, balanced, well-diversified Canadian investor, as of the end of May, sits on a year-to-date return in Canadian dollars of roughly 3.5%. Further gains for the capital markets will require a continuation of the more reasonable tone from the White House, as opposed to the move fast and break things approach that culminated in the Rose Garden on April 2nd. It would be naive to think the path forward will be smooth. Indeed, many hurdles remain. However, we can see from recent capital market results is that when the tariff threat is reduced to a reasonable level, capital markets believe the global economy is healthy enough to absorb the shock. We have said that things can get back on track. Despite the volatility thus far in 2025, there is no deep hole to dig out of yet. Our 2025 capital markets outlook, along with that of many others at the beginning of the year, was optimistic. The faster the world can get to some reliable understanding of the rules of the game on trade, the less damage inflicted, and the better the outcome for the capital markets. Macroeconomics, particularly the trade, monetary, and fiscal policies of major economies, remains a significant influence on capital market outcomes. However, regional, sector, and company specifics still matter. The current environment is one where active investment management can shine. Monetary policy is divergent between the U.S., which is staying restrictive for now, and much of the rest of the world, which is more eager to ease. All governments are set to keep spending a lot of money. This presents investment opportunities in defense industries, infrastructure, and key industries being targeted by amped-up government industrial policies. Corporate earnings growth is coming in solid and better than expected, illustrating that corporations, and by extension consumers, face this trade shock from a position of strength. We believe the most aggressive policies of the new U.S. administration are not aligned with accomplishing their goals, a reality that is becoming clearer to key individuals. What is achievable, sustainable, and congruent with the laws of supply and demand in a modern capitalist system will eventually weigh in and exert influence. The extent of the impact required to force change and the time it might take are unknowable, and these are now the greatest sources of uncertainty. However, they will work. Our investment stance, being slightly overweight in stocks, is predicated on this trade-off. Our positive view that the feedback loops will position things in a way that allows the world to digest and adapt, tempered by the negatives of the time and magnitude of the feedback required to reach a semi-steady state of affairs. Our well-balanced and well-diversified portfolios are performing well amidst the recent volatility, proving yet again this approach stands the test of time and weathers all manner of circumstances. That's how we saw the month of May. Thank you for joining us. We look forward to you tuning in next month.